Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and today I want to go over highest returns. Someone asked me, how do you get the highest returns? What do you do? And most people are going to say, oh, take on all this risk, go in a bunch of exploration companies. I don't think that's going to yield the highest returns. You're going to have a strategy and a mixture of all of it. I'm going to go through kind of what this channel does and how it prepares you and how you can obtain what I think are the highest returns over a very long period of time. So let's jump in here on what I put together here. So, oops. I'm going to shrink me down a little bit. So tying it all together is going to give you the highest returns. You buy undervalued sectors. You choose low risk, high return strategy wherever you can get that. And what's a low risk, high return strategy? Well, go after a riskier precious metal like silver, but buy it at the right time. That's a low risk physical metals. Buy the physical metal, take delivery of it, and then do a swapping strategy. Whenever the ratio is cheap, whenever silver's, undervalued, you buy it, you hold it, becomes overvalued, and then you swap it to the undervalued metal, whatever that metal is at that time. And I have a couple of scenarios where I have very good returns and even beat Warren Buffett's return in his, yearly returns. It was like 38 or 40% per year using rhodium, palladium, silver, gold, and platinum as our metals to swap around. It's going to require lots of patience. This isn't something that you're going to get rich quick. It takes time. And you have to be patient, and you have to wait for these valuations to get cheap. You have to wait for the valuations to get overvalued before you do your swaps. And I think that you're going to have to incorporate technical analysis on the big picture view to give you an even greater possibility of return. You can kind of see where we've been and how things are changing in relationship to history. And real estate's probably the most stable, predictable rise of prices compared to anything in the stock market. The stock market's very volatile. It likes to crash out. Real estate is really, once it gets into a recovery phase, it basically just goes straight higher the entire time. I think it's a very easy way to invest and hold something because it's not nearly as volatile. And it's also something that you can control more of. You can control getting a good deal in real estate. You can control your putting sweat equity into a house and adding value to that house. There's more control in real estate than there is in a stock. A stock, all you can do is control when you buy it, and then you're kind of subject to the whims of whatever the market's going to do. So I think real estate is a very good spot to make a lot of money in terms of adding value into real estate and cash flowing real estate. I do think that's a good spot to be, especially if you're buying in a bull market of real estate, which we're in. Now, I talked about this choose low risk, high return strategy. Another way to say it is risk adjusted returns. I'm heavily weighted in physical precious metals because of the risk-adjusted returns. It is a low-risk, high-return proposition, and then I do my ratio analysis on swapping the metals. That's why I choose that strategy, is because the risk is so low and the returns are very good, where I put a large chunk of my money in it. I know a lot of people think that you should just go all in on these higher-risk things, but if you're going to go high risk, these returns better be huge, because they have to beat the low risk strategy. Because if you have a low risk strategy and you can't beat it taking more risk, or if the risk is so much greater and the returns are not that much greater than your low risk strategy, you want to pile in your lower risk strategy, compound it more over time with more money. That's going to be a better return and approach than taking on far more risk for just a little bit more return. So if you look at kind of my strategy and what I've talked about on the channel, I have a lot of money in my low risk my low risk, high return physical bullion swapping of metals, which I don't swap that often, guys. This is literally you hold it for like 10 years, 5 years, something like that. So you've got this strategy over here. And then if you notice on my high risk strategy, I kind of go all in on the high risk because if I'm going to take the risk and I'm taking that risk at the lowest risk spot, because you can have a high risk thing, but you're going to buy it where it's the best time to buy a high risk company is when everything's been deflated out of it. I buy that and then the returns can be massive. And that's the only reason I go after those high returning things. I'm buying what I think is one of the lowest risk opportunity times to buy it. And I hit the full risk button, the full send. I don't do this middle of the road thing because the returns are not nearly as large. And if you're at a low risk spot, you want to hit the high risk button at the lowest risk area. So there's no point of going with a low risk company in a low risk area when the returns are going to be muted and you can't even beat your low risk strategy, high return and physical bullion. There's no reason to go into some of these companies that are large, like an ExxonMobil or a Chevron. They don't have the returns. I can beat them in physical metals. I would rather take the lower risk in physical metals than deal and subject myself to a company that has a identity crisis, calling itself an oil company, but is putting people on the board of renewable energy. I don't even know what this company is even trying to be. It's still coming out of the closet right now. And that's not trying to be mean to anybody. I'm just saying they don't know what they are. And I don't want to be in that transition period. So I push the ratio analysis and swap metals around. See comment, section for the video. I'll put that ratio analysis in the comment section. So if you want to see what that is, that low risk, high return strategy, it's in the comment section or in the description. Super low risk, good returns, better than the S&P 500 average, and I'm out of the system and diversified. So that's another reason I take this low risk, high return strategy with physical metals. Now, if you're going to take risk, if you're going to push, the highest returns possible, and you are going to take the risk you are going to take better have massive payouts. You need to beat your low risk physical precious metals approach. I would not choose a lot more risk for only a little more return. And I was talking about that earlier. Long term's about compounding lots of money at good rates over time. If you're young, that is what I would do. I would have a large physical metals position and do the rotation. Swapping of metals, again, that's in the description below. I have not lost a single ounce of money. You like that? Doing this method. You like that right there, huh? Single ounce. But I've made tons of money in this method. I have not lost at all. I've never lost doing this method. Sure, I've gone up and down. Sure, I've been down in some of my positions at a certain time, but I've never lost over the long term. It's been 100% gains. And I've gained quite a bit, especially on my palladium holding that I bought in the mid-2000s, late 2000s. It went up substantially. Made a lot of money there. And, things to watch out for. I'm not a huge fan on taking lots of money and putting it all into exploration companies. You're going to have to position size those correctly. I don't think you're going to get the highest returns taking all of your money and just dumping it all into the riskiest things. What I like to do is I like to put a very little money in the riskiest stuff where the probability of not getting paid out is quite high. But if it does pay out, it pays out massively. So I do put some money in it. I position size it correctly in relationship to my entire portfolio. I'm in this for the long game. And if I have a very low risk approach where I know I can get a super good return, I'm buying it at below the cost curves. I'm buying it below a very good ratio. It's an anomaly of its ratio. I'm going to pile into it. I'm going to pile into it massively, hundreds of thousands of dollars into it, not a $5,000, $10,000 position. I'm gonna pump it. And there are more risks in taking large stakes in companies that don't control their sales price, which are commodity companies. But, a huge but here. If you get it right in commodities, you win big, and that is the draw to them. You can win massively in a short period of time. You can have greater returns than most technology, probably any technology company, depending on the commodity price and how fast that rotates for you. Also, conversely, if you get it wrong, you can also lose a good amount of money. So don't put everything in it. Don't go 100% of your net worth in this. Diversify it out. You don't have to go massively diverse, but I might only have 20 to 30% of my entire net worth in commodities. Everything else is spread out in other things. And that's probably a good allocation. I've got real estate. I've got physical metals. I'm hitting the low risk button far harder than the high risk stuff. And over time, that's going to give you higher returns because those low risk, high returns are going to have a higher probability of payout. The high risk stuff can get you better be a very good investor. You better know this stuff inside and out, because if you buy it at the wrong time, you're going to get smoked in a lot of these commodity type companies if you don't know what you're doing. If you know what you're doing, then you can make quite a good bit amount of money, but the returns will be so big that you can take a small amount, risk a small amount, and still get a huge payout. So you don't have to take on all the risk. You don't have to hit the full risk button on everything. But I mean, that could be a strategy if that's what you want to do. Just make sure you position it out, get a bunch of different sectors, a bunch of different companies. If you're going to do the full send on everything, you better spread that thing out and at least hit a few of them. But I don't do that. I've worked too hard for too long to lose too much to hit the full risk on everything. So hopefully this helps you in your investing. I want to just touch on the highest returns. If you're a young investor and you're trying to figure this stuff out, remember you can take the low risk approach with very good returns and compound it longer. That might be a strategy with a good portion of your money. Physical metals, swapping those physical metals around. I put it in the description link of what that is so you can identify what it is. That strategy. I deploy that strategy with 20 to 25% of my money, my entire net worth. And I'm continually making that adding to that strategy when the prices are good. So hopefully this helps you out. Give me a thumbs up if you guys like this content, and thank you for listening. This is Finding Value.